Welcome to the APREA Property Market Update. My name is Hideki Suzuki from Cushman & Wakefield, Japan, and I'm a chairperson of APREA Research and Market Intelligence Committee. This episode finds us in conversation with the three prominent researchers in the Asia Pacific, who are also members of our Research and Market Intelligence Committee at the APREA. Dr. Yan-Lian Chuo from ARA Asset Management in Singapore, James McDonald from Savills in China, and Prashant Thakur from Analog Property Consultants in India. Thank you so much for joining. It's wonderful all of you joining today. So just set up the stage for our discussion. So as soon as trade-related tensions between US and China had a bit of ease earlier this year, the Asia-Pacific region found itself at the forefront of the COVID-19 pandemic. Asian countries immediately acted to contain the virus, announcing lockdowns and border control, which also has been a really difficult balancing act with economic activities. Still, the situation continues to be unpredictable. However, we also started to hear some positive news, such as GDP recovery in both China and Japan, booming luxury retail sales in China, end of lockdown in India and some other markets as well, acceleration of e-commerce, and of course, some success of vaccine development. The world is definitely seeing Asia Pacific as a leader of return to normal or return to new normal. Today, we will discuss the current market situation of the major Asian markets and outlook, where we're heading towards. Right, thank you very much, all of you joining today. Right, just as with the first questions, let us understand the current situation in your market and rent pricing, new COVID cases, government initiatives and policies, lending conditions, etc. Dr. Cho, could I start from you?
Certainly. I think the case in Singapore is like any other countries in Southeast Asia. We have been quite lucky. So far, our COVID cases has been quite stable now. For a couple of weeks, we had actually zero infection. Only recently, we had a couple of more, just 1 or 2 a day. And that's been the case for the last couple of weeks. And on the back of that, the government has been slowly unwinding some of the policies, social restrictions. I think clearly one of the key reasons for doing that is that we do need the activities to resume to continue to support the economic growth in Singapore. For example, I think the government here is testing out some new controls in terms of MICE activities by allowing some 250 participants, for example, in separating to 5 zones, using rapid tests to make sure that nobody's infectious while they attended the event. And all that is on the back of new technologies using online as well as physical as well as holograms to encourage the kind of activities and new styles of MICE activities. Government also has supported through measures such as the financial aid to companies, especially those affected by the pandemic, which support as much as 75% of the employees for almost 10 months. And all in all, the cost to Singapore economy is about 100 billion in total by about October 2020. On the property market front, it's interesting. I think that many other markets here in Asia, you'll find that there's a bit of a disparity in some of these sectors. There's correction going on right now, and the correction is quite ranges between minus 0.5 on a quarter-to-quarter basis to as much as 4.5% quarter-on-quarter in this recent third quarter. The residential sector, interestingly, is the one that is holding fairly well. The correction is just about 0.5 on the rental market. Cap values, on the other hand, continues to rise. And I think that's the kind of disparity you're seeing across in Singapore and some of other markets in Asia Pac. And that's really on the back of heavy capital, the weight of capital is around, and the availability of refinancing options. So it's a lot of optimism among investors, both domestics and institutional cross-border. They expect the conditions to APAC to probably rebound fairly quickly after we have seen some kind of vaccine for the market. Back to you.
Right, thank you so much. Yeah, thank you so much. So Prashant, is this similar to what you're seeing in your market? Is India already full out of lockdown?
No, India was one of the countries that imposed the strictest, one of the most strict lockdown. And it was necessary at that point of time because looking at the kind of population we had to manage and the kind of infrastructure we had to deal with this pandemic. So this lockdown kind of helped the government to take the control of the infrastructure initiatives. And today, we are in a situation where the COVID is under control, and the lockdown more or less is lifted completely, apart from few of the restrictions like, the school and colleges are still under lockdown. There are restrictions in public gathering, and then, but most of the businesses are back to pre-COVID level. And we had a very strong festive season in terms of retail sales. We recorded good amount of interest in the residential sales as well. So yes, I would say that post lockdown, the business and then the industry is slowly gaining momentum. Government has been very supportive both in terms of policy and providing liquidity into the system. RBI has maintained its accommodative stance, and the interest rates are kept at a lower level. Though the risk of inflation still hinges, considering the huge amount of liquidity that is coming into the system. Government RBI has clearly conveyed to the market that they will continue with the accommodative stand, which has helped the industry in a greater way. So now coming back to the different asset class of the real estate, it can be to start with residential, then retail, and then commercial. Residential gave a positive surprise during festive season, where a lot of buying happened, and then government initiative has also brought a lot of hope in the market in terms of keeping the home loan interest rate low, which resulted in a very attractive home loans. And India is going through one of the best affordability in terms of real estate, if you talk about. The developers were also quite proactive. They offered good payment plans and schemes to push the inventories. And few of the states like Maharashtra, they offered a cut in the stamp duty, which boosted the sales. Now coming back to the commercial real estate, the office segment, 2019, if we talk about, was one of the strongest year for office sector, both in terms of leasing as well as completion. 2020, the office sector has taken some kind of beating because of COVID-19, but I'm pretty sure the sub-dollar rental advantage that Indian office sector provides and the kind of talent pool that we have, I think the sector will slowly come back to its previous level. The good part is that the rent collection for all the listed developers has been quite strong, and we haven't seen the huge amount of cancellation of deals happening. In fact, the players have gone ahead with pre-commitments, and that's where we see some kind of inherent strength in the Indian office sector. That is quite evident from two successful REIT listings that we saw, and a couple of them are in pipeline. If I have to give my opinion on retail and hospitality, I think these two sectors will take time to recover, because they were one of the hardest hit segment because of COVID-19. Though the retail malls in India have opened up, there are still cinema complexes and food courts that will take time to come back to its pre-COVID level. And hospitality still is really under some sort of travel restriction. People are still not taking up business travels, though things are slowly opening up. So in my opinion, I would say that we are gradually coming out of this COVID-19 related slowdown. And somewhere in mid of 2021, I think once the vaccination is out, people are more confident about their well-being. Things will start to come back to normal.
James, how about China? Of course, China is the lead in the recovery in Asia Pacific, and everybody keeps an eye on China. And we are hearing a recovery in retail sales, especially luxury goods. What's your view on that?
Yeah, I mean, obviously we were one of the first countries to be impacted by COVID-19, but we seem to be one of the first ones that have recovered, both in terms of the economy, retail sales, hospitality, many other sectors. Similar to Singapore, we've also seen a significant rebound in terms of residential sales. Again, most of the transaction centres, most of the actual sales in the first, or not in the first couple of months, but in sort of February and March were pretty much closed. And so I think it was by roughly June or so that we started to see volumes into the residential sales market pick back up to similar levels to the previous year. And I think for July, August, September, we're actually seeing residential sales volumes in excess of what we were looking at last year. Obviously, China's a massive country, and so there are sort of regional variances in terms of that. But generally speaking, we've seen a relatively positive residential sales market. When we look at the office market, I think similar to many other countries, that we've seen a reduction in terms of rents. We've seen a slight drop in terms of occupancy rates, but I think because we are looking at a sort of slightly earlier economic recovery, that we're actually starting to see some of those occupancy rates stabilize in the third quarter. We've seen net take up improve compared to the first 2 quarters. So that's starting to improve. I think one of the reasons why the occupancy rates are a little bit better than we were previously expecting is because we've seen a number of projects delaying their handover, which is putting less supply pressure onto those markets. But that's not stopping the landlords from being concerned about the demand side of the actual equation. And so we are actually starting to see in certain markets quite a significant rental incentives being offered to tenants to attract them into recently handed over projects that were handed over in 2019 but hadn't reached the degree of stability that you might expect in a more mature market. Within the retail market, as you mentioned, the hospitality market, we've also seen quite a swift recovery in terms of those sectors. This is partly because we've seen improvement in terms of people moving around the country. We've seen a pickup in terms of domestic air travel. I think we're now down at only down 2% year on year in terms of domestic air travel for, I think it was the month of September. We saw the national holidays, we saw roughly 630 some million trips over that 8-day period. That's really being supported by some of the government initiatives, whether it be the night economy, street stores, shopping festivals, the dual circulation system, which I think a lot of people are quite familiar with now within the China market, where China can't really rely upon outside parties to consume all the products that China actually produces, but they're actually looking at driving the economic recovery and driving the demand side of the equation through domestic consumption. So it's really being encouraged from that perspective. And the part that you mentioned in terms of luxury retail sales, Chinese buyers have always, or Chinese individuals have always been significant buyers in terms of luxury products. But a lot of that consumption doesn't normally take place within China. It takes place when the Chinese national is on holiday in markets like Tokyo or Singapore or London or Paris. What we're actually seeing now is because you can't travel internationally, that luxury consumption is still taking place by the same individuals, but just taking place within the China market. And again, that's being actively encouraged through policies like the expansion of the duty-free market down in Hainan, where we've seen an expansion from 30,000 RMB to 100,000 RMB in terms of the quota that individuals are allowed to purchase duty-free in Hainan per year. And so that's going to have a significant impact as well.
Oh, wow. I think that China is really on the way to recovery. Oh, that's all positive. Thank you. So can we just touch on base on
just to add to that?
Yeah, sure.
I mean, it all seems positive at the moment, but I think what everybody has to understand is that everybody's working towards a recovery in terms of current market conditions. But this is all going to be, all of this is going to result in subsequent years seeing slower growth because we're bringing forward a lot of the stimulus, and you're going to have to pay back some of that, or you're going to have to reckon with some of the forces which have been built up over this year. In terms of in China, we see sort of bank forbearance, which has meant that none of the banks have called in any of their debt at the moment. That will start next year. So we're going to, once you see the economic recovery, then you have to start to then deal with the bigger issues about what this has actually created over the last year in terms of the debt markets. And so that's going to be one of the bigger issues. So I mean, in China, the leadership is already starting to think about that and starting to deploy measures to start trying to mitigate some of the risks that have built up over the last 12 months. So just a few months ago, we saw China introduce a policy called the three red lines, where they're actually looking at levels of developer debt. And if they cross certain thresholds, then they're not allowed to issue additional debt or expand their overall debt exposure. And so these things are going to start to build up, and it's going to slow growth down. Just as we're starting to recover to a certain degree, we're going to start to see new measures being introduced to actually start to address these longer term issues which are built up this year. So we are getting back to normal, but there's still a lot of work to do.
Yeah, I think we actually have a similar story down in Japan. The stimulus package prepared by government is really, really encouraging, which is equivalent to like 40% of the national GDP. That's massive money and massive stimulus. But the question is, what's going to happen after we recover? Are we going to have too much debt? Then we have to have another problem that we have to face and deal with.
Yep.
Thanks. Right. Can we just touch on the capital market activities now? As you already know, the pre-COVID-19 situation, pricing for real estate industry or market was perceived already peaking across Asia, but probably not only Asia, but also globally. And now we're seeing a bit of dispersion in terms of cap rate movement along different sectors and locations. For example, Japan, hotel and retail sector expanding cap rate. Multifamily sustain the current level of cap rate, and office is going to see slight expansion in coming months. And logistics and data center industrial assets are seeing actually cap rate compressions. So Dr. Cho, what's the situation like in your market? How do you suggest taking advantage of this turbulence?
Yeah, well, despite all the negativities that we've been hearing about in the economic conditions, I think generally speaking, the yields in Singapore for the asset classes has been fairly stable. Capital values are usually quite sticky on the downturn. And like I mentioned earlier, I think the weight of capital that's floating around the region, looking for instruments for investments, and a lack of really, I mean, bond risk is pretty low, interest is very low at the moment. So where else do they go? Hot money keeps flowing back to real estate. So generally speaking, in Singapore, yields are quite stable. And for me, in a risky market like now, it's always good to adopt a more defensive strategy, such as focusing on fundamentals, that is sectors or assets that is short by strong demographic trends, healthcare, aged care, lifestyle homes, and as well as economic trends. That is what we are seeing today. We hear so much about the big data, digitization, right, or digitalization of assets. So data centers, industrial, cold storage on the back of vaccines and food requirement, all that seems to favor quite well among investors right now. And to me, retail and office is also good investments at this time. If you're taking more of a contrarian view and take a more long-term look on where these sectors are moving, there is pretty much a lot of potential for value add repositioning, and this is where depending on where your risk strategy, your risk and your investment strategy is. I will avoid international hospitality at this moment, just because we do not know how long before the borders, international borders, are fully open. But I'll focus more on more of a regional level kind of hospitality, meaning around the regions. We're going to talk about that. We've seen that happening already. On the back of the US-China trade war, there's been a lot of the regionalism that is rising. You have Europe, you have Americas, you have Asia. So they kind of regional trade's been rising on the back of that. So I would go with regional travel, hospitality type of assets. And these are likely to be the continued growth drivers post the pandemic. Equally for Singapore, I like cold storage, I like industrial assets, especially for central kitchen, because on the back of F&B and delivery trend in Singapore, we found that industrial assets, especially those that are food and beverage centric type, especially for central kitchens, tend to outperform. And separate state, given the digitalization of the economy, we also noticed that private credit, e-credit platform has also shown quite substantial potential as well. Back to you.
I see. Thank you. James, are there any investment opportunities emerging alongside this turbulence, particularly unique to your market, or probably the ones you're actually seeing earlier than Asian markets?
Yeah, I think a lot of the sort of investment trends are going to be quite similar to some of the other markets, just to sort of different extents. So we obviously, compared to markets like Singapore, we're significantly underinvested in terms of, sort of data centers. Logistics are sort of outdated, or they don't have the capacity that's required for some of the cold chain storage facilities, etc. And so I think there's more opportunities there, but there's also many more hurdles in terms of trying to get the money in, trying to get the regulatory approval, trying to get the sites in the right locations, finding the right local partners. it's a relatively sort of new market, and there's a lot of obstacles which will be in the way for that. So some investors have the ability to be able to pivot into new asset classes and change their strategies. Other investors are finding it quite difficult to do that, or they're not comfortable enough, or don't have the requisite skill sets, the asset management capabilities to be able to do that. So they're digging deeper into some of the more traditional asset classes to find sort of the niche subsectors within the more traditional asset classes. So we're seeing some investors maybe sort of focusing on sort of business parks or sort of more decentralized locations where there's some opportunities where per square meter costs are slightly lower, or maybe looking what the life sciences R&D facilities, maybe sort of digging deeper into where's the demand coming from, which industry clusters you're looking at in different locations, not just saying, look, we'll buy an office building anywhere as long as it's a good quality office building, but really delving down deeply into sort of which tenants, which industries are really anchoring that one location. Or say within the retail market, it may not necessarily be a high street retail facility, but it may be more of a community retail facility, so a smaller scale, where the per square meter price again is lower, where potentially the yields are slightly higher, where the tenants are a little bit more sort of stable, but there may be some operational efficiencies which you can actually generate in some slight uplift in terms of the actual asset itself. So it's about delving deeper into the traditional asset classes, not just, again, riding on the cycle, as many sort of investors may have done in terms of sort of cap rate compression, capital value growth, but really sort of delving into sort of subsectors to try and find areas of strength. And then also, if you have the ability, then to look into some of the new niche asset classes, especially the ones which are being supported by the government. I mean, we're talking APREA, so one of the big things for China this year has obviously been the announcement of the REIT regime. And the REIT regime primarily is targeting some of the sort of the infrastructure assets. Now, infrastructure in China is a relatively broad category, and so many people are looking at what sectors, what niche sectors are actually included in that. But I think there's a general consensus that obviously the more traditional infrastructure, such as highways, airports, seaports, but also logistics and data centers, generally considered to be included within that sort of REIT regime. Some people may go a little bit further than that, but generally speaking, I think there is a tremendous amount of capital, amount of investment, which can be borne onto the logistics and the data center markets going forward, and also increasing number of exits available to those investors, which is incredibly important. And so I think that's a key focus that we see in China. Again, similar trends to elsewhere, but just maybe sort of to different extents within the China market.
Sure, absolutely. Thanks a lot. So Prashant, has your or your investors' clients' strategy or investment strategy shifted due to the COVID-19 outbreak, such as the change in sector allocation or asset allocation?
India has always remained in a very unique situation, I would say sweet spot. Investors in India were always looking at yield generating asset, and the Indian office sector, as well as retail, as well as hospitality, were a good bet. Residential took a back seat because of various back-to-back regulatory changes that were brought in that led to a kind of disruption in a positive way, and the low rental yield anyways were not very attractive for investors. But I would say even after COVID-19, the investment strategy of various clients who are looking at India as probable yield generating investment avenues, their investment strategy has not changed much. I would say that retail, for the time being, they would have taken a pause. They will take some time to discuss, but their investment focus and strategy for office sector remains intact.
Okay, next question. Right. Future of workplace or future of office. I think that's a really big topic that we have to address in this episode, in this session, right? So some survey indicate that the majority of office workers globally want their companies to continue remote working options after COVID-19, which suggests, of course, workplace is no longer a single destination for office workers, but workplace will be more kind of like a network of physical and virtual environment for people to perform the best. So James, do you see this as a threat for office or less demand?
I think with everything, you can't just see it as a threat, but you have to see it as a threat and an opportunity at the same time.
True.
And I do think maybe that survey is saying the option to, not that it's mandatory for you to work from home, but you have the ability to work from home. And maybe that it's not 5 days a week, but it's 4 days a week in the office and 1 day working from home. So I think there is a degree of nuance in there. And if you do work in the office 4 days out of the week, then does that really mean a significant change in terms of the actual office space requirements? So I think that's really the big question. And I think I think in Asia it may be slightly different to other markets as well. I mean, we were talking earlier before this call, and you were asking me how far I lived away from the office, and I said, look, it's only about a 15-minute commute for me. Now, maybe many other people are not as lucky as me to only have a 15-minute commute, but I think the commute times that we see in Asia was sort of significant, especially in China, with sort of the investment that we've seen in terms of infrastructure. Commute times tend to be shorter than if you're, say, stuck in the US or back in Europe, where you're having to drive into the office in the morning and you get snarled up in terms of traffic jams. So I think the convenience of going into the office minimizes the advantages of working from home. At the same time, if you're living in a city with 24 million people, the size of your apartment is going to be a lot smaller than if you're living in a little village out in the UK, which has maybe sort of 100,000, 200,000 people. So in those contexts, you don't necessarily want to stay at home. If you're staying in a sort of a 40 square meter, 50 square meter apartment, you maybe want to break from that. You want to go into one of these new beautiful grade office buildings that is being developed with sort of these breakout locations, things like that. So I think just purely from that sort of regional perspective, the options available to you outside of the office space for working in a third location are relatively limited. I think also in China, say some of the business management structures or the way that people work together can also be quite different as well, depending upon which company we're talking about. If you're talking about SOEs, it may be that you really do need the manager to be able to see their employees and see what they're doing. They like to have control over everything, all the aspects in terms of the work environment. If you're talking about domestic private companies, they may be a little bit more flexible. If you're talking about multinational corporates, maybe even more flexible again. Then you also have to look at the different industries, whether you're in a creative industry or whether in a much more sort of regimented industry where everybody knows exactly what they're doing, everybody works by themselves, and you have the occasional sort of catch-up calls or meetings. In other ones, you need to be able to be in the same location as everybody else, feeding off other people's sort of creative ideas. And so I think it's specific to sort of the management style of the company. It's specific to the industry, and then one of the other things, I mean, I've got sisters back in the UK, and if they live by themselves, then they need that emotional support, that emotional framework to actually go out and meet other people. If you're living by yourself, and increasingly households are in single person households. So what is your personal interaction with other people? For many people, the office is the interaction. I mean, we did a similar survey to the one that you're referring to back in the UK, Savills UK. And if you actually break down the different age boundaries, age brackets, then actually the younger people are the people that actually want to go into the office, because a lot of them have rented apartments in the city centre. They're living in a flat share or sort of single bedroom unit, and they want to go into the office because the office is their friend network, is who they are. It's their social network, is their colleagues that they work with. And I think also one of the key debates, so I don't need to go on, but one of the key debates is whether you actually have that that cohesion in terms of teams over longer periods of time. Now, if you work with a colleague for the last 10, 20 years, the ability to be able to work from home and still have that personal relationship with your colleagues is still there because you've known them, you've met their families, you've gone out for drinks and things like that. But if you're onboarding somebody in a work from home environment, then do you build up that bond with your colleagues? And so therefore, do you have that cohesion, or do you understand them well enough just through a couple of Zoom calls or team calls? So I think that there is a debate, the short-term impacts and the long-term impacts. You may be short-term positives and productivity and everything else, but if you look at it over mid to long-term, do you continue to have that cohesiveness in terms of the way that your company works together? So I think there's a number of debates there. Some of them are sort of global, some of them are sort of regional in terms of for individual sort of cultures and locations and management styles.
Yeah, thank you. Yeah, absolutely, I agree with you. You know, the workplace will be not, as I said, will be the single destination for people. It's gonna be the place for people to focus on like three C's, right? One is the culture, collaboration, career development. Career development includes training. That's the place where you can create a bonding and a culture and everything to be connected with your colleagues. So I think the true role of workplace before COVID is more like a boxy, where the manager put their people and they just see their people working in front of them. From that into more a place where people collaborate and enjoy the feeling of belonging to the company and also the culture, and cultivating all those like a good social connectivity with their people. So yeah, absolutely. I think the meaning of workplace will be much more than that, more than before COVID-19, right?
Yeah,
I think this is
as many people said, I mean, COVID-19 is not necessarily changing anything; it's just accelerating the trends which are already there. So we are just seeing that again within sort of the future of the office. We were looking at these trends prior to that. I mean, the development of co-working, the ability to be able to then sort of work remotely from anywhere. I mean, that was already there. It was just an acceleration in terms of either the technology advancing or the adoption, or people just trying it for the first time and actually saying, well, it's actually not too bad. But I think that there will be a swing back eventually. I think in the situation of China, because our lockdown was relatively short-lived. I mean, most of China went into lockdown, Chinese New Year, January 25th ish, and then we didn't come back, or sort of businesses didn't start until February the 10th, and then many people working from home for another couple of weeks. But then people started to trickle back into the office by the end of February, and then sort of most people were back up, sort of depending upon these sort of regional differences. Most people were back at full occupancy, maybe sort of around about sort of May or so. And so there wasn't as much of a sort of a systemic sort of change in terms of the way that people worked. And so I don't think it's had as much impact in China as it may have in other locations, where you may be working from home for a 9-month period, or back into lockdowns, or selective working from home because sort of the number of virus cases are a little bit higher. And so I don't think it's had as much of an impact in China. I think what's going to happen is China's going to revert back to the way that pretty much revert back to the way that we were before COVID-19. But I think the rest of the world will move on and find new management styles and new technologies, and then we'll gradually absorb some of that in China going forwards. But I don't think in China that we'll necessarily lead that. I think it will be maybe following some of the other markets where we've seen more of a progression towards sort of the future, the way of working. And we'll maybe sort of gradually adopt that as we go forward, not because of the pandemic, just because it makes sense going forwards.
I see. So, Dr. Cho, so this kind of a discussion of future workplace or future for office demand is it's a little bit tough question for investors and investment managers as well. So, how to add value to office? The kind of add value to the office strategy or office building that you own or you manage as a real estate investor. Sorry, a little bit tricky questions for you.
Yeah, well, no, this is fun. I think, like James mentioned, you've alluded to. I think first and foremost, I think every location, every city would have its own unique shift. As James mentioned, in China, perhaps the lockdown was not as long and arduous as some other regions around the world. So that will have impact in terms of what kind of value we are talking about. But all in all, if I may say, just how I look at it is purely from the shift in terms of what you guys have talked about, the 3 C's that you said, Hideki. So there is so much of that social element in there, the collaborative, that inter-social and inter-colleagues kind of features that we need to take into consideration. In the past, office used to be very functional. It's just a roof over the head for you to operate, be like a factory, just produce and produce and produce. But as the new era comes in, the rise of communication changed, we have seen a shift as well in the way people use the space. So how I look at it from perhaps 3 areas: the software and the hardware, and the shift in culture. So definitely current challenge really presents opportunities for assets owners and landlords, or even developers, to re-engineer their offerings. And we look at office as a communication platform. By communication, I don't mean a telephone. He's providing the opportunities for occupiers to connect with the internal colleagues as well as external community. And not just physically, I'm talking about, but digitally as well. And this will be a very important differentiator for the asset, to look at your asset not just as an asset, but as many of you have said, real estate as a service, but in this case, service as a communication platform. So one, the physical space to house the occupiers and the environment needs to be relooked at. We need to encourage the accidental as well as the planned meetings by re-examining this concept of common areas. Very often our common areas are just relegated to the space between the lift lobby and your security checkpoints or waiting areas, but that has to be relooked at it. If you look at before the COVID, many cities, many countries have tested, some places as far as Australia, they've tested introducing social spaces for people to come together, either as a co-working, but in a public kind of a concept. But with the lockdown, of course, all that changed. But post-COVID, I believe with technology, with proper controls and hygiene and safety in mind, that kind of concept of what the common area is, not just a space that's relegated to just a coffee stand or some chairs by the corner, right? Second, the technological infrastructure for the building. That is, of course, we talk about internet connectivity, the IoT of the building services itself, and the apps to connect the tenants, the occupiers, with the larger community. Here is not just within your building, but external to your building, to the occupiers next to you, to the retail shop that is down your street, all that as a community as a whole. And then repositioning all these offerings by providing greater social and health components into the building. So the building's real estate office is not just a physical space, but as a service. And that's very important for occupiers going forward. So the new designs that we need to implement and complement has to meet the expectations of the new millennial work style. And that's essentially boils back down to flexibility and their desire for integrated services. So to me, I think the future of office, the single zone office space may no longer be as attractive as it was in the past. The single zone use that we have seen in the 1980s, 90s, well, as early as 60s, right? That has to give way to a cleverer way of integrating other parts of activities of our life. So as what the URA here in Singapore has been pushing for, the work, live and play element, that's going to be a lot more prevalent now going forward. For developers of new office, I think this would be an excellent time to incorporate sustainability. But here I don't mean just the environment, but these social aspects as well into the hardware and software of that project.
I mean, maybe if I can just add one follow-on comment on that. I mean, obviously, as you apply more technology, you actually spin off more data in terms of how people actually use the office space. And so I think what is going to be a tremendous benefit of this is better understanding how tenants actually use office space and that continuous evolution in terms of the way that office space is going to be designed based upon that data. And we already know that some of the co-working guys had already started to crunch all the data that they were gathering in terms of their users. But I think it also gives an opportunity for us to look at how bigger companies use their own personal space in terms of how you actually fit out that space. What is non-essential, what is essential, where to invest more, and look at the productivity gains that actually generates for the employees and for the company itself. So I think there's a tremendous amount of information and understanding that we can get about how people use space, and that can inform our future generations in terms of office space.
Thank you. Yeah, Dr. Cho, you also mentioned really interesting point, the co-working space and the kind of soft service of the building. Currently, because of the COVID-19 situation, people refrain from going outside. So less collaboration, physical interaction or collaboration. That means less demand for co-working and satellite office option at the moment. However, there's another things happening too in the co-working space. They're actually receiving lots of increasing amount of queries in terms of how they can really contracting with those like satellite office options rather than having only single dedicated office within co-working space, right? So I think the office strategy will be or likely to become more like a hub and spoke type, that kind of strategy, having headquarters in city core market, then having satellite office close to the residential area, right? So this is a question for Prashant. The strategy is, as I say, is likely to become hub and spoke type. What about suburb office or satellite office demand in India?
I think a lot will change in the office sector. It will, in long run, impact the office sector in a positive way. during this pandemic, the entire world kind of tested the concept of work from home. People are forced to work from home because of this pandemic. Most of them were apprehensive about productivity loss, but to everybody's surprise, most of the companies and almost all of them reported their output and their productivity level exactly at the same level when they used to work from office. And to some extent, large deals and mergers and acquisitions were concluded during this pandemic without even entering the office. But having said that, I would say that a hybrid model would evolve, and it is evolving, where the office will remain at the focal point, but the concept of work from home, work from anywhere, flexi spaces would come gain prominence. The corporates would use this flexibility to attract talent, because the next gen highly mobile workforce would need some kind of flexibility. Now, let's say few of the workforce, let's say few of the non-client facing roles might permanently shift from office to work from home. There might be certain amount of workforce that might be required to come to office, let's say twice a week or thrice a week. Let's say companies will also give the option to their employee to work near their home, and they might take flexi spaces or let's say satellite offices near to the place where the employees reside. So I would agree that going forward, a hub and spoke model would evolve, similar to what we see in airlines industry we have seen, which has been very efficient. So there are a couple of benefits in a country like India, where you end up spending a lot of time on road commuting to and fro from your work to home. There's a lot of productivity loss. Now, if you have this option of satellite offices, employee would be free to kind of choose on as per his schedule, as per his day, as per his activity that is planned to work either from the main office or choose to work from satellite office. And the office design also would change now, because of the social distancing and other hygiene factor that needs to be accounted for. I would see especially for countries like India, the average space required for in the office would increase. There was a phenomena pre-COVID in India that the corporate houses were trying to consolidate their office space to one big office. They were giving up small satellite offices and trying to bring their workforce at a single grade A office. That would change, because during COVID-19, what we saw, because of restriction in certain areas, not all the offices were allowed to open. So as a business continuity plan, the companies would also not think of having multiple offices within a city. They might have 3 or 4 small offices spread across, and then they will have one corporate office. So kind of decentralization of office space also might happen. What would benefit the office sector is that net effect of offtake would remain same, or let's say slightly increase, opposite to what we are thinking that the companies might be giving up space because of work from home. So the situation is still evolving. The companies and the corporates are still waiting for this pandemic to get over, or at least stabilize, and then they can start to work on their strategy of how do they realign their workforce, how do they bring back the workforce back to the office. And you'll see a lot of models evolving, as you said, hub and spoke, mix of co-working, flexi spaces, work from home, or let's say 3 days a week kind of stuff. So yes, this is going to be an interesting phase once the corporate world starts to bring back their employees to work either in office or let's say from any other location.
Right. James or Dr. Cho, if you have any thought around this, like a satellite office demand, what's happening in China and Singapore, Southeast Asia?
Well, I think we've seen a couple of trends again, even before COVID-19. Again, it's just the acceleration of trends we've seen before. But I mean, obviously in China, you got the regions like the Yangtze Delta, the Greater Bay Area, where the government was looking at setting up these clusters of cities where you could look at the value chain of an industry and then identify opportunities within that cluster of cities to be able to again separate out certain functions of a business. So we're already looking at potentially a business of separating their business functions between different cities in a region where you've got lower cost base or different expertise or different clusters in terms of subsectors. So I think that was already taking place. And I also think what's important to understand is that COVID-19 is not just a sort of a transformational impact, or it's not just a health concern, but it's also having a massive impact in terms of the economy. And so the impact that's going to have on the office market is similar to what we saw during the GFC. So you're going to see sort of tenants looking at reducing costs, they're looking at decentralization in terms of the office spaces. So there's also going to be sort of those types of factors. What we're seeing in some of the cities in China is that companies are maybe consolidating, moving further out of the city centre, trying to reduce costs. Potentially, again, using some of these co-working spaces, not necessarily as a hub and spoke, but as a sort of a more agile workspace, where they sort of pretty much certain about their 80% requirements in terms of office, but they need that degree of flexibility, but they don't want to take on excess office space and excess cost, and so they'll look at sort of co-working spaces or flexible space to be sort of a buffer in terms of their demands, so they can grow and shrink based upon market conditions. So I think we're still seeing that playing out, that we are looking at companies looking at reducing their fixed costs through sort of different office requirements.
So now in Singapore, I may just add, I think the situation is you can look at it from both the supply and the demand conditions. On the supply side, the urban planners here in Singapore has been advocating for the growth of a decentralization, decentralized office spaces, and on the back of that, the new land supply has been limited in the CBD area. More areas are being provided for in the suburban areas. Like say you hear about Jurong, you talk about Tampines, which is really a developed area, Paya Lebar. All that is part of the government's or the urban planners' effort to push the decentralization, or rather to rebalance, because the issue is that you need to bring some jobs back into the suburbs, into the areas, and avoid over dependence of the CBD for the white collar jobs, as well as to avoid the congestion into the CBD area. So that's been ongoing for quite a long time in Singapore. COVID essentially is a catalyst for the whole trend that we've been seeing. So that's likely to continue from a supply side. On the demand side, as James mentioned earlier, I mean, if you look at Asia, density is high and apartments are tiny and shoe boxes are plenty, right? So if you're living with 5 other household members, with 2 kids and 2 parents and your spouse, you probably want to get out of the house where you're working. Nothing with that. Both husband and wife, you probably prefer to get out of the house at some point. And I think that's where these kind of urban offices would tend to trend well. Already seeing that, I think that what happens right now is we are working from home because there's no alternatives. If you go into the suburbs, you may not find any conducive spaces, right? Unless you're living in a huge house, chances are you're going to be working on your dining table together with your kids who is studying online, and your parents who is in the kitchen making a lot of cooking sounds, right? So that's kind of environment that Asians are living in, and I think these suburban offices would probably do well depending on the model. And I think if you cater to that kind of flexibility, be it a hub and spoke, whatever it is, I think it will be quite attractive from a demand side, from a demand perspective, providing alternatives, that is.
Right, thank you very much. Right, this is the last questions for you guys. So outlook, there are so many shapes in economics view, right? Like a V shape, L shape, U shape, Nike swoosh shape, or whatever shape. So what would you think, or how would you describe the shape of your market recovery and timing? What's your focus? Probably starting from James.
I mean, if you believe the government figures, and we've already seen a recovery in terms of the market. We're already looking at, again, office spaces being pretty much fully occupied. We're looking at there's a 4.9% growth in terms of the economy in Q3. So we already have seen a recovery. We've seen businesses getting back to normal. But like I said before, I think it was on the first question. Then I think the repercussions of this are going to be felt over the next 5 to 10 years, it is going to put back longer term economic growth quite significantly, just because governments and business, or governments have had to do so much to keep the economies up and running, and businesses have sort of obviously had a massive impact in terms of cash on hand or their sort of revenue generation this year, that it will take some time for them to recover. And so in some sectors of the economy may never recover. We've also seen a number of countries starting to look more inwards in terms of sort of internal domestic drivers, and a lack in terms of globalization. That's going to have an impact in certain industries and certain regions as well. So I think the longer term implication, I think obviously in China we've seen that V rebound, but I think the opportunity for higher levels of economic growth have been impacted obviously by what's happened this year. I mean, I don't know if you want me to talk about the property market or just the economy, but I mean, obviously, it's just so hard to forecast the nature. I think, like I said, the biggest issue that I think many countries are going to be faced with is the debt issue. I think there's just so many corporates, so many individuals that have taken on additional debt, so many governments have taken on additional debt. How do we get ourselves out of this situation? And what the implication is going to be for the long-term growth? That it's just going to take a long time. And as I said, certain industries have, I mean, the F&B sector, the airline sector, the hospitality sector, some of these are going to see fundamental transformation in terms of their business, or a rapid consolidation of their markets. And it's going to have profound impacts, and it'll take a long time to figure out what that's going to look like going forwards.
Thank you. Yeah, absolutely. It's a really difficult to forecast, and we definitely need to do different again based on different scenarios, right?
Yeah.
Something that is really interesting to me in Tokyo is normally, like if you think back to what happened during global financial crisis, GFC, all those companies with a poor performance, they cancel the office space. But what we're seeing right now is actually those companies who benefit from this COVID-19 pandemic, they're also reviewing their office footprint and consolidating the smaller space into the headquarters. So it's not really the similar phenomena that we saw during global financial crisis, but it's actually really different kinds of phenomena that's happening in Japan now. So very, very interesting interesting things happening right now. Dr. Cho, what's your view on the recovery?
That's really the zillion-dollar questions, right? I think if you just look at the trend in Singapore, compare the latest quarter that we have seen and the earlier preceding quarter, I think the contraction has been slower. That's a good news. So we are looking at about 5.8% contraction year on year in the third quarter in Singapore. And this is on the back of a 13.3% year-on-year contraction in the quarter earlier, in that second quarter. And that's really supported by the phased reopening and the resumption of economic activities in Singapore. So that's very important here. I think everyone else in every other country is all depending on that resumption of economic activities. So our MTI, the Ministry of Trade and Industry, expects that the Singapore economy should contract about 6 to 6.5% for full year 2020, and then perhaps recover by about 4 to 6% in 2021. To me, I think it is definitely a possibility sometime in 2021. I would reckon probably second half of 2021, and that's because Singapore, as many of you know, is a really open economy. It's often regarded as the barometer of the world activities. And given the unevenness of the policies we are seeing today and the strategies adopted by various countries, from China to the US, with very contrasting policies that they have in combating this pandemic. So the recovery of the global economy is very likely to remain quite tepid in my views and very uneven. And I see that the Singapore economy is going to mirror that. So possibly more of a Nike swoosh kind of a look, with occasional spikes and dips going forward, depending on how fast the vaccines are readily available to the general population across the world. Because otherwise, you're going to keep seeing this rise and fall of cases, and that's where social lockdown is going to happen. Seen that happening in South Korea at the moment. We're hearing now fears rising in Taiwan because of imported cases. So that kind of scenarios continue to play out until we have a secure way of controlling the spread.
Right. Thank you very much. What's your view, Prashant?
If we look at the second quarter GDP number that came out for India, it was a positive surprise. The contraction was much, much lesser than everybody anticipated. And it was, again, backed by strong data. In residential real estate, we saw almost 60 to 70% recovery pre-COVID level. As I said earlier, that office segment has not seen a lot of cancellation, or let's say a lot of companies have retained this space. And in fact, few of the major corporate houses have gone ahead with their expansion plan. Now, if you look at the broader economy, India is typically a consumption-driven economy. The inherent strength of the country is its huge population and huge consumption base. And that's where the government, through its mechanism, has been trying to push a lot of schemes to the market that provides money in the hand of the people, and then also confidence. RBI has played its role quite well. They have maintained the liquidity level at a very good rate. And then, the kind of job losses the country was expecting, that has not happened. To everybody's respite, the job losses has been moderate, and the small and medium enterprises are coming back very quickly. So if you account into the factor, the pent-up demand, the huge consumption base of India, and then not to forget that the agriculture sector has done quite well in India. While other sectors are still under pressure, agriculture as a sector has performed well. So in my opinion, if you look at the kind of recovery we are expecting, I would say it would be a V-shape. As of now, the data suggests steep recovery, because the kind of fall that we saw was also unprecedented. The kind of contraction we saw during first quarter of this year was huge. So in my opinion, if we have a better control on the pandemic, all the fundamentals for the country is in place. The only missing piece is that when does this consumer confidence starts to pick up, which is slowly picking up. And I think with the positive news around vaccine coming, and then the kind of moderation that we're seeing in COVID numbers, I am a strong believer that there is a high possibility of a V-shaped recovery for India.
Okay, so we're finished now. Thank you very much, all of your invaluable inputs. Really enjoyed the discussion. Really helpful and very insightful. That's it. Thank you very much.
Thank you very much for your moderation as well.